So a lot of people call the IUL rich man's Roth IRA.
Please remember, this show is for educational and entertainment purposes only and is not intended to be investment advice. Welcome back to the Money Seed Podcast. Today, my guest is Mel Lieber. Mel is the CEO and founder of Financed Premiums. Mel, welcome to the show.
Well, pleasure being here. Thank you for having me, Gabe.
Mel, give us a brief introduction. What is Financed Premiums and how did you get into this finance world?
Okay, I love those questions, Gabe. You're like, that's a softball. Okay, let's go for it. So here we go. So a little bit about me. So my name is Mel Lieber, and I grew up in a super finance-oriented family. When everybody else at the dining room table was talking about what was on TV the night before, in my family, it was finance, numbers, investments, and that's what we spoke about. I was the youngest of four. And as a little kid, as a 9-year-old, as an 8-year-old, I thought I knew the stocks, which stocks are the best stocks. Every Monday morning, I would run to the newspaper, the New York Times, the business section, look up the ticker symbol of the stocks that I thought were the best. If you're too young to know what that means, don't worry about it. You Google it. And every morning I would check my stocks. Oh, my stocks are up, my stocks are down. Pretty much I was just copying whatever my father and brother were talking about. And I was interested. I was excited. And fast forward 30 years, and my father was a successful insurance industry financial planner for 50 years. My oldest brother ended up opening a hedge fund, and he's one of these super successful hedge fund managers who, whatever you're thinking of, that's him. And then my sister ended up becoming a financial planner, while raising a family, very successful. And then my next brother, he became a day trader at Fifth Avenue for one of these high-performing funds. And then it was me. What am I going to do? So I have to, it was up there. I had to reach. I had to do something amazing. I had to work at it. And, I had the family pressure and the interest and a little bit the genes. So I had to figure out what I was going to do. So I didn't want to join an industry that was just about who could scream louder than the next guy. So I wanted to find something that could really help people. I could really make a difference. I could really use the skills that, thank God, I was blessed with to be able to try to really help people and make a difference. So I investigated all different types of investments. I spent close to a year just investigating and researching different types of investments until I came up with until I found premium financing. Premium financing, what that is, in short, is we take an investment that is a very safe investment, something that has built-in caps, which is going to make it safe. Well, I can explain that in more detail maybe later. But we take a safe investment that's going to grow on average 6, 7, 8, 9, 10% a year, obviously depending on lots of different variations. And we are going to borrow money from a lender to actually pay for the investment, to put the money into the investment. Historically, the investment grows at a higher rate than the cost of money. And therefore, we're going to be able to have a net gain arbitrage on the growth of that investment. We're going to house that investment in a life insurance policy in order to take advantage of the tax benefits that come along with the life insurance policy, which pretty much allow it to grow tax deferred, and you can actually access the money tax-free. And therefore, I found this. I'm like, this is my baby, and I thought that this is an amazing way for people to invest their money, which most people were not aware of, except the super high net worth were aware of, but everybody else wasn't aware of. And therefore, I wanted to bring this to more people. I wanted to help people. It wasn't about any more screaming louder. It was about how I could help you with something that you don't know of. It is complex. That is one of the complications of it. But that's really where my skills are. Try to take that complex topic, try to explain it to you in a simple way, and try to navigate through that complicated field in order to bring each individual person the best option for them.
Mel, let's start at the basics. So I think I got the first bit somewhat down, right? Which is I go to the bank, I borrow money. Let's say the bank gives me a good interest rate. Let's say a couple of years ago it was 3%, 4%. Let's say I take out a loan at a low interest rate. I take the bank's money, I invest it, and the returns I get on my investment are higher than the money I'm paying on the loan. And there's that little arbitrage. The difference between the two is really my profit, right? So I'm borrowing money, let's say at 3%, I'm investing it, I get a return of, let's say 8%. The difference of 8 and 3, that 5% is really just my money. So I'm using the bank's money to make money for myself. It sounds like that's the basic idea here.
Yes, that is the main idea. You are straight up correct. With your own money, you're limited unless, your last name is Bezos or something like that. So you're limited with your own money. This is really the trick that all the wealthy people have been using forever, is the way to get wealthy, the way to get real returns. And this goes really across all industries, is when you're able to take advantage of other people's money. Now, and it sounds a little bit dirty. It's not dirty at all. The bank's very happy to do it. You're taking advantage of other people's money, and you're not just limited by what's in your pocket, but you're able to access this additional funds, and that's able to really take your potential gain from here all the way up there.
Yeah, Mel, and I would say that most people are familiar with this, or most people like me come across this in real estate, right? Because when I'm buying an investment property, that's what you do. You go to the bank, you finance it, and it's like, yeah, investment. I'm just buying this property as an investment. I'm not living in it, and I'm using the bank's money to get the mortgage to be able to buy the property. And I think in that framework, it makes sense. And so, what does the insurance part of it do? That say, how is the product that you're marketing, how is that different from, say, a typical real estate investment?
Okay, so that is a excellent question. So really, if I would want to compare it to something, the closest comparison of what I do is to real estate. That is the closest comparison. But I'll explain to you a couple of reasons why it is different. One fundamental reason why it is different is real estate, we know, is a very good investment, safe investment usually. And we know when you borrow money from a lender to invest in real estate, you get money for very cheap. It used to be you're getting money at 3.5%. Maybe nowadays it's closer to 6%. But the bank's giving you money cheap. Why? Because real estate goes up 95% of the time. And since real estate goes up 95% of the time, that's considered a safe investment. The bank will give you a good rate to borrow the money at. Now, there's one thing that's actually better than 95%. That's something that doesn't go down 100% of the time. This investment that we're working with is you're contractually guaranteed that it will not go down in value from one year to the next. So therefore, 95% of the time, real estate's good. But there are those 5% of the times, which I'm agreeing is not the standard thing. Usually you're going to be good with investing with real estate. But we actually see it right now. I actually spoken to a lot of people recently who have invested in multifamily syndications around 2 years ago. If you invested 5 years ago, you're great. But if you bought on the high 2 years ago with a floating rate, there are people that got in at a cap rate of 4. If you don't know what the cap rate means, don't worry about it. But people got in at a cap rate of 4, and now they're paying interest payments at 6. Then they're getting a 4% growth and 6% interest payments. These deals are underwater. This doesn't usually happen. But actually, right now, I'm getting calls from people asking to, please, can you have any ideas for me? There's something to do. Unfortunately, I don't have any magic wand to fix that situation. But right now, we're actually witnessing one of those rare situations where people are going underwater investing in highly leveraged real estate. Whereas this concept, since it's contractually guaranteed not to go down below your principal every year, the lenders are actually going to lend you at a cheaper rate because they have much less risk. And for the individual investor, there is much greater safety in the fact that you're never going to get that margin call, so to speak, that people are seeing in the real estate world today.
And I think you're absolutely right. And sadly, I've heard stories as well about some syndications going under. And you're right, it is a very precarious time in real estate. So getting back to the insurance part of it, I think maybe that's what you were getting at, is that there is a type of investment that typically doesn't go down, or doesn't go down most of the time, or doesn't go down at all. Maybe tell us more about how this leveraged investment with a life insurance product can overcome that hurdle.
Okay, so I'm going to actually tell you with a little history, a little story. There was what my father and probably your father bought once upon a time, whole life insurance, which was, at the 80s, it sounded like a great no-brainer idea. At that time, they were earning, 10% a year. It's, it's guaranteed not to go down, so to speak. And it was earning, let's say, 10% a year. And because the growth of these policies were very connected to the interest rates. And therefore, when interest rates were super high, the growth of these whole life policies were great. And everybody was happy. Great idea. It has all the tax benefits. It has a nice return. This is obviously is going to continue forever. And everybody was very happy. Now, as the years went on and the interest rates ticked down, and the whole life, they had like a 4 or 5 year lag tracking the interest rates down. Eventually, what happened is, come the year 2000, and people start saying, wait a second, that whole life thing kind of stinks. It really started off really good, but I like the idea of 10% returns, but now we're getting like 4% returns. And, actually maybe at that point it was still 5 or 6, but by 2010, it was going down to 4.5%, 5% returns. Now it's down to 4% returns. And people have started to think this is not exciting anymore, this whole life. By the way, I'm not bashing whole life. There's a good place for whole life. It serves a good purpose. It might be a little oversold in my opinion, but there are definitely a time and a place for whole life. Now, people wanted higher returns, because 4% isn't so interesting, 5% isn't so interesting. So when there's a need, the industry develops, and they came up with something called the IUL, which stands for Index Universal Life. Now, what Index Universal Life is in terms of taxation, it's going to use the same exact tax code that whole life took advantage of. But instead of your money growing at 4% steady a year, similar to a treasury bond, its growth is relatively closer to stock market type growth. Its growth is going to track an index. Now, for years and years, the main index that people use was the S&P 500. Without getting too involved right now, everything's switched in the marketplace to low volatility indexes because of the high option pricing on the S&P 500. That's a little bit complex. Maybe we don't need to get so involved in that right now. But the industry has switched to low volatility indexes, which pretty much is you're never going to make 40% like you'll make in the stock market. That's never going to happen. But you're also never going to lose 30% like you'll have in the stock market. The way that these indexes work, you're getting in them with caps. So you're getting a guaranteed floor of 0, and the way that it's designed without getting too complex, but you're never making more than 15% in a year. Mm-hmm. And these types of indexes will, obviously, depending on which company, and lots of details, which is up for me to figure out for my clients, you're going to make 7, 8, 9, 10% a year in these indexes. And it's going to have that same growth, that same tax advantages of the whole life. However, there are those people still today who are these, what I call the CD type people, who they don't want to see, wait, I made 0 this year, and I made 0 the year after that. Oh no, the world's coming to an end. So if for that type of person, who, the person that won't put money in the stock market, only buy CDs, whole life is there for you. Take advantage. If you check the other boxes, that whole life makes sense, that's for you, Mr. CD. And listen, I'm not here to judge everybody. It's not my personality, but I'm not here to judge anybody. I understand if somebody is risk adverse, that is okay. And the IUL is not the right fit. That is a whole life guy. But somebody who wants to see, listen, I'm going to put on money. I want to look 20 years, 30 years down the road. I want to know, where am I going to have the highest rate of return? So within the IUL, when structured properly, I'll explain in a minute what that means, but when structured properly, the rate of return is going to be much higher than the rate of return of a whole life. And that's the basic idea of IUL, and it's been gradually picking up speed in America over the last 15 years.
Got it. Okay, so I think I'm starting to put it together, Mel. So maybe walk me through the difference. So hypothetically speaking, even if I don't want to get an insurance policy, I can take some of my money and I can open a trading account, a brokerage account on any one of the platforms and just buy, let's say, an ETF. I can just buy the SPY or the SPX or something. Now, it seems like I can also take on a little bit of leverage and buy on margin and increase my maximum gain, maximum loss, and now you're saying that there's a different way to use leverage inside this IUL, right? This index universal life policy. Maybe walk us through how is leverage used differently, and how is it different than me just buying it through a regular brokerage account?
So it's a great question. So it's actually the way that it is actually done isn't particularly different. Meaning the idea that you get leverage for your brokerage account, you get leverage for your real estate investment, and you get leverage for this product is pretty much the same. The only real difference is usually getting the money cheaper for this product because it's a safer investment. But the concept of leverage is the same. What the difference is the inherent risk. If somebody has, a dollar for dollar matched in their margin account, so if their account drops 50%, they get what's called a margin call, and they lose all their money. And, like I was just looking over last night, I looked over there's something that they call a deck, which people, when the syndicators, they send out real estate investments. So a lot of my clients, even though this isn't what I officially do, but when you become that finance guy, they hit my desk, these syndications. So a client of mine was joking around with me the other day. He says, take this look at the one that you told me not to do 2 years ago. So there was a deal that I saw. It had what they call a cap rate. The rental return was a 3.7. And it had 85% loan to value. There is no question in my mind that this deal is underwater right now. Because, listen, if it has gone down in value, it's not like you could sell this deal and get out. Since for sure gone down in value, and you're not covering your rents, you're messed over in that deal. This deal does not go down in value, the IUL type investment, because it's guaranteed not to be reduced. So it's the same, more or less, benefits of using leverage without the risk. Because if it can't go down, you're never going to get that margin call.
Got it. And maybe walk me through, Mel, when you say it can never go down, what is it about the policy that allows it to never go down?
Okay. There's two answers to that question. I always ask my clients, do you want to know where the gas pedal and the brake is? Or do you want me to open up the hood and show you exactly how it works? So for those that want to know where the gas pedal is and where the brake is, there is a contractual guarantee that your investment funds will not go down. And that's the simple answer.
Let's say, hypothetically speaking, I have $100,000 and I want to invest it, and I want it to be a good long-term investment, and maybe get into it and start thinking about some of the tax strategies for when I pass on, or how I'm going to leave it to my kids, etc. But let's say that I can just open up an average brokerage account and boom, dump it in an ETF versus investing with the product you're describing. What are going to be some of the differences in both the growth of that product over the next 10, 20, 30 years, and what happens on the back end with the taxes when it comes out?
Okay. So let's deal with it a couple of ways. Fine. So in terms of your brokerage account, what the growth is going to be, we both don't have the crystal ball to be able to know what that growth is going to be. Meaning if you went, fast forward, rewind 20 years and put that $100,000 20 years ago into Amazon, I'm not going to beat that.
Fair enough.
So it's I know a lot of people in my industry, they like to just make assumptions. And, I know people in the last 20 years that made an absolute killing in the market. And I know people that lost everything in the market. So it's very hard to know.
Mel,
we play averages.
I'll make it easy on you, right? Let's just use the historic. Let's say the S&P 500 on average gets 8% per year. Perfect. Let's just use that for the sake of the argument.
Okay, excellent. Perfect. That's what I like to do. Okay. So this investment, the IUL, without the additional leverage, right? Without the additional leverage that I bring to the table, in terms of what wins the IUL versus the S&P, it's very, very dependent on which time period we are referring to. Some time periods the IUL has historically won, and sometimes the S&P has historically won. The S&P has won more often than the IUL. Okay, but it's very dependent. But however, here's the caveat. The caveat is in terms of the taxation. If somebody is the type of person that is going to be in a high tax bracket, is going to be paying some reasonable amount of taxes, the IUL wins. If somebody is not going to be paying any taxes because they're just putting a couple of bucks in, they're a low tax bracket type of person and they're just putting a couple of bucks in, then I would say the S&P will usually win.
Interesting. So this looks like it's a preferable product to people with higher incomes and higher tax brackets.
Correct. Now, when you factor in the leverage that I work with, the additional funds, which by the way is only really available, apologies, but is only really available for somebody who's a little bit of a higher tax bracket type individual. So then it for sure wins against the S&P 500. But there are a lot of people out there who are telling every person out there, it doesn't make a difference where you are financially, to go for the IUL versus the S&P. I don't necessarily agree with that. It depends on a couple of factors. One factor is the S&P needs a little bit more of a stomach than the IUL, because you'll have those 2008s where if you don't have the right stomach, then the S&P could really hurt somebody. But if you have the stomach for it, and once again, we're talking about a low tax bracket person, and you're just going to close your eyes and open it up in 30 years, then I would probably advise the S&P over the IUL. Though but it is a personal choice in that regard. But the other advantage of the S&P over the IUL, and this is what I always tell people, is if you need the money soon. If it's reasonable that you're going to need the money in 3 years or 5 years, let's say you're going to need the money in 5 years. You're in the S&P, you will probably have a decent gain over the next 5 years. In the IUL, if you decide to take all the money out in 5 years' time, you're going to probably have zero gain. So it's a long game. If somebody has a strong possibility that they are going to need the money in a short term, the IUL is not the right fit. And I don't like people who oversell it.
Got it. And how much leverage are we talking about, Mel? Like to make your numbers work, to make the IUL work, how much leverage do you typically need?
So to make the IUL work, you don't need any leverage. The IUL works just fine, getting you 7-8% without leverage. What I like to do, because I don't just want to work, I want to kill it. So what I would like to do is we'll call them the high earners, but not the ultra high net worth. So for them, we usually use approximately 3-to-1 leverage. For every dollar that they put in, we have a lender put in 3. It's very similar to a classical real estate investment where you're putting 25% down and you're borrowing 75%. When we get to people who are high net worth and have much more sophisticated portfolios, if they have, for example, lots of liquidity in let's say a brokerage account, and if putting too much money in will trigger gift taxes, so then we'll often set it up differently where they'll only put in 5 or 10% of the funds. But that once again is really to avoid gift taxes, and it's when they have the liquidity to access capital in case there's some issues and it doesn't perform so well in the earlier years, they have a place to go to bring some extra funds in. But that is a little more sophisticated than I like to do with my average doctor, attorney, dentist type of client. So a lot of people call the IUL rich man's Roth IRA. For those who are familiar, in the world of IRAs, there's 2 basic types of IRAs. There's what's called the traditional and what's called the Roth. Traditional is where you put money in pre-tax and you pay taxes on whatever comes out. A Roth IRA is where you put money in post-tax and it grows tax deferred, and you get able to access it tax-free. But the Roth has lots of limitations. And most of my clients make more money where they aren't even allowed to use a Roth. And you're only allowed $6,000 into a Roth. So therefore, it's obviously very limited. So this is like that type of taxation. You put post-tax dollars in, and it's going to grow in a way which is tax deferred. You're not going to pay taxes every year. And when you take money out, it's going to be tax-free. When it comes to your general ETF mutual fund, it depends exactly how it's structured. Sometimes you have to pay taxes annually, but you always have to pay taxes when you take that money out. And as I imagine has been discussed on the show many times before, we all know the taxes are going up because unfortunately, this is not a political issue. I don't care which side of the aisle you sit. America has a problem that they are spending more than they're bringing in, and that national debt is going up, and they have things like Social Security, which they're going to have to fund it from somewhere, and they're going to have to pay their debt. They don't want to default, and even though raising taxes usually isn't good for the economy, but they're just going to be forced to do it. So I know when I retire and when you retire, all the economists are predicting taxes will be higher. So therefore, when you put your money into that mutual fund or ETF, it's kind of like, here, I'm putting the money in, and IRS, you'll decide later what you want to charge me. That doesn't make me so comfortable.
And Mal, I agree with you 100%. I think long-term, our taxes probably are going up. And but getting back to this idea that you can withdraw it tax-free, it sounds like you keep deferring taxes, right? It's like the taxes are deferred, but at some point, the investment will have to pay taxes at some point, right?
Okay, so great question. Here's how it works. There's a code, there's an IRS code, which stipulates that the death benefit of life insurance policies are tax-free. In theory, you should think about it. Any individual that has it's a difference what type of life insurance they have. But over the course of their life, they paid in $100,000 into this life insurance policy. And now the person passes away, I don't care what age it is, and gets a $500,000 death benefit to their beneficiaries. Under the normal rules of taxation, you would expect that's a $400,000 gain. And presumably the heirs would have to pay taxes on that $400,000 gain. However, that is not the case. The reason why that's not the case, and they don't have to pay anything, is because it's the government's way of encouraging the purchase of life insurance. Because the government very, very, very much wants people to have life insurance. Because if it wasn't for life insurance, anytime anybody would die young, that their dependent spouse and kids would be on every government program out there. So therefore, life insurance is really a major protection for the government. And one of their ways of, being able to get people to purchase life insurance is by allowing the death benefit to be tax-free. Now, that still doesn't answer how the funds are accessed during your life tax-free. So the way that it is when I get the money from the insurance company, officially what I'm doing is something that they call a policy loan. I'm, so to speak, borrowing every dollar that I'm taking out to spend. I'm borrowing from the insurance company. Now, I'm borrowing it to pay for my retirement, to pay for my vacation, to pay for my car, whatever it is I want to pay for it. And between me, you, the insurance company, the IRS, and everybody else in the world, everybody knows I'm never paying that money back. They're just going to deduct it from my death benefit. So nobody's ever paying that money back. It's just deducted from the death benefit. Now, we all know that we're just kind of using semantics in a way to call it a policy loan, but that is what is allowed, and that's what works. And there's nothing that's going to ever change because the government wants this to be in place. And even if I wouldn't borrow from the insurance company like I'm doing, I would, in theory, be able to go to outside lender anyways and put in my life insurance policy as collateral and borrow from an outside lender. There's a way to make it work, but it's definitely a lot simpler to do it within the insurance company, and that's what's done. it's a little loophole, but it's not a new loophole. This loophole has been around for approximately 80 years. And it's not a secret. It's not like this hush-hush loophole. The whole industry is built in this loophole, and everybody knows, as I said, me, you, the IRS, the insurance company, we all know that when I take that policy loan, I'm never paying it back. It's just deducted from the death benefit, which is tax-free. And the fact that it's a loan, we all know that if I go to the bank and say, could I borrow $50,000? I do not owe taxes on that money that I borrowed from the bank. That's not earnings. That's borrowing. That's a loan. There's no taxes on the loan. So there's no taxes when I borrow the money from the insurance company.
Mal,
That's pretty clever.
I think I got the whole picture now, and thanks for explaining it, because it's starting to make sense now. So I take my own money, I invest it, I open up an IUL policy, and then it becomes taxed as though it were, which it is, in fact, a life insurance policy. So that's how you talk about the beneficial taxation. And if I need to access that money, I'm not withdrawing my own money. Technically, I'm borrowing against my death benefit, right? Which in reality, I don't have to pay back. It just means if I pass away, my death benefit is going to be paid out less because I took some money out of it earlier. And so I think everything makes sense now. So thanks.
Yeah. And I just would add that one little point. As your policy grows and the invested money goes up, so your potential death benefit would be going up. So it's not like you're minusing from your death benefit per se. I mean, your death benefit is going up when your investment returns are rising, and therefore you're taking away from those additional funds that you would have gotten by using them. I mean, the more you use now, the less you have then. The less you use now, the more you have then.
If someone signs up for one of these policies, are they committing to an annual contribution for a certain number of years?
The simple answer is yes. The simple answer is usually the way that we set it up. Definitely if you're using the leverage version, then yes, you're committing to usually 5 years, a 5-year commitment generally of that payment. If you're using the non-leverage version, then you're not technically committing to a contribution every year, whatever. But if you don't end up making the contributions that are designed and planned, then the return will not be nearly as good. One of the things, a caveat that I threw in earlier, is I said it's a great investment when structured properly, or it will compete with the S&P when structured properly. What I mean by structured properly is when you use something which we like to call max funding, which is you put the most money in that you're allowed to for that amount of death benefit. You want more money in, less death benefit. Because whatever death benefit it is, that is going to eat away at some of the growth. So the more money you have, the less growth that gets eaten away. So if we design the plan for you're going to be able to put in $30,000 a year, and turns out you only put in $10,000 a year, even though when I sat across from you from at the table, you said you're going to put in 30, and you only ended up doing 10, then this will not be a good investment. Mm-hmm. I'm not saying you're going to lose your money, but your growth is going to be not impressive. So is it a commitment like that I'm going to hold you to? You're going to lose your money? Not a commitment, but it will change it from a good investment to a pretty boring, mediocre investment.
Got it. Mel, I know that on the internet, there's a lot of people using the term infinite banking. Is this similar to that concept?
So the infinite banking concept could be applied to this as well in the same way. So that is not my focus per se, because what I'm doing is really that on steroids. Because that's just focusing on the positive loan and tax treatment of these policies, which we do have. But in addition to what most of those people are talking about, I like to work with things that have higher level of growth.
Mel, what is your ideal client look like?
My ideal, a guy who has $3 billion, who says, Mel, here's $1 billion, figure out what to do with it.
Okay, well then I'm out.
No, all right, but on a serious note, most of my clients are people who are, what we would call high earners. Who are most of my clients earn two, three, four, five, six, $700,000 a year. Who are a lot of them are doctors, attorneys, dentists, orthodontists, accountants, small business owners, people that could put away at a bare minimum $20,000 a year. A lot of them put away $50,000 a year, but most of these are people that need to save for retirement, which is almost everybody. People that don't like paying taxes, which is almost everybody that earns that type of money. And also, I want to point out, sometimes when people are like 65 or whatever, 60 and up, I'm not saying I can't do anything for the 60 and up, but it's much more limited what I could do for the older crowd. Because as I pointed out, this investment is only really going to beat the market when there's a long time frame. In a short time frame, it's not going to win. So if somebody's 65 already, the math might say that you're better off putting your money in the S&P 500 than doing what I'm advising. So therefore, I'm not going to go advise you to put money in this investment if you could do just as well or better on the S&P 500. So usually, 30s, 40s, 50s is the ages that I normally work with.
And Mel, is this a policy that some of your clients set up for their children in their children's name, or?
So yes and no. I'll explain. I actually, another thing that makes me, I guess, weird if I am in the life insurance industry, is I am not a believer of child policies. I know a lot of people pitch them, and I personally I do not believe in them. I believe if there's no insurable need, it limits the advantage. Also, you don't get such good ratings on the kids. I'm not such a big fan of it. I think you'll do better in the S&P 500 than buying children policies, personally. However, I do have a lot of people who have, they've became a client of mine at age 50 or whatever it is, 55, and then they've bought for their adult children. And that I'm a big believer on. To buy for the 25-year-old kid, the numbers are amazing. It's wild. It's great. I'm a very big believer in buying for the 25-year-old. I'm not a big believer in buying for the 7-year-old.
Interesting. Yeah, no, Mel, thanks very much for your interesting takes on the life insurance industry and these policies that are available. It's not a commonly held view, I must say. And so I appreciate your time today.
I know that. I'm also part of the thing, just like I'm a super numbers guy. So I like comparing all the numbers, really running all the numbers, doing Monte Carlo scenarios to try to figure out all the different possibilities and all the pros and all the cons and all the different things. And therefore, since I am really technical with these things, I sometimes reach different conclusions than people that just, like to, daydream and think about what's good.
So Mel, in that case, I got to ask you. So if you run your numbers and your financial models, if you're comparing apples to apples, right? Me putting my money into an S&P 500 index through my brokerage account, or me getting a 2 or maybe 3x leverage and investing it in an IUL, accounting for, let's say, the entire life of the product, 20, 30 years before I take it out, you look at the taxes on the back end, et cetera, what kind of returns would I see through the IUL versus my regular?
Assuming that you are, let's say you will be taxed at a 25, 30% rate when you're taking out, you'll get approximately double the amount of money going with what I like to work with, versus putting your money in the S&P. Once again, I'm not talking about if you bought the Apple or Amazon of 20 years in the future. We're talking about average S&P returns. Then yes.
Incredible. So then that works out to roughly, and I know we're just talking hypothetical numbers here, but if the S&P 500 is getting me on average 8%, in this case, I would be getting somewhere around twice that, right? 16%-ish, give or take.
No. Rewind. There's compounding interest. Doesn't work like that. 16% compounding versus 8% compounding. The 16th, by the time you retire, 16% would be worth like 10 times.
Right.
What, the 8% compounding? So I'm not talking about not double the rate of return, double the cash in your pocket at the end of the day.
Got it. Okay. Thanks for the clarification, Mel. I got it.
Yeah.
Good. Okay, cool. Mel,
Yeah.
fascinating discussion. I mean, where can people find you to learn more?
Okay, so everybody could always shoot me an email, which is my email is mel@finance premiums, FINANCED premiums, PREMIUMS. So .com, or they could check out my website, financepremiums.com. I'm redoing it. I'm done in a couple of weeks.
Sounds good. Mel, appreciate your time today. Thanks very much.
All right, my pleasure, Gabe. Thanks for having me, and it was a really enjoyable conversation.
Hey, thanks for joining us for another episode of the Money Seed Podcast. Please remember to click like and subscribe. It really helps spread the message to other investors, and it helps attract new viewers to the show. We appreciate your support. Thanks very much.